We are more than halfway through earnings season, and as you know, the focus this time around is on 2019 guidance. That's because there's a real concern that the earnings growth that we've been seeing may not last. Bob Pisani explains.
There's been a growing chorus of concern over slowing global growth. More than 40% of earnings in the S&P 500 occur outside the United States. So when you get a big multinational company like a Caterpillar or an NVIDIA mentioning a slowdown in the global economy, well, that's a major issue, particularly for industrial and technology firms. So the battleground is now between those who believe earnings in 2019 will stay lower but still positive, and those who believe that an earnings recession is around the corner. Now, an earnings recession would be 2 or more consecutive quarters of negative earnings growth. That's a big issue, and it's not a trivial question. The last time we saw 2 straight quarters of declining earnings was in 2015 and 2016. The S&P was close to down 0.7% in 2015. That was the only down year from 2009 to 2017. So right now, estimates for first quarter earnings are down to a measly 0.4%. That's a big decline. We were expecting 8% growth for the first quarter at the start of October. And revenue estimates are holding up, but they're down a little bit too. So this begs the question, revenues are still holding up relatively well, but earnings growth is heading towards zero. That's kind of odd. This implies that profit margins are under pressure, mostly because of higher wages and higher raw material costs. We saw that today from a simple company like Church & Dwight. They make well-known consumer products like Arm & Hammer baking soda, OxyClean, and Waterpik devices. They cited rising transportation and raw material costs, partly due to U.S. tariffs. And they started raising prices on their goods, though it hasn't been enough to offset some of the margin pressure. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.